This session of Visual JForex, we will be continuing our algorithm development using the indicator standard deviation. This indicator gives you the idea for the momentum, on which side the momentum is, whether it is bearish or bullish. You can use this indicator to look for the opportune time to get involved. Whenever there is sudden spurt in the price action, if it is jumping on the higher side or it is jumping on the lower side, you can capture both these developments using this deviation indicator. So we will see how we can design and develop the algorithm using this standard deviation tool. This is the setup so far. I had carried out the instrument subscription. This time around we are using the USD JPY as our default instrument. The position amount was defined at 0. After that, I have taken these two hourly standard deviation indicator blocks with varying shift values 1 and 3 respectively to consider the standard deviation with 2 hour interval, so as to make sure that whenever there is sudden change in the values in a short interval like 2 hours, we can be fairly confident of a sustained move for at least next couple of hours in the same direction. So we will be relying on that. And to look at the direction of the price action, we will be relying on the get historical candle, and also we will be comparing this hourly candles closing and opening prices to determine certain requirements. And on the 4 hourly candle period, we are also taking the prior data, how the price action was 4 hours back. So that will give us idea if it is going to be sustained or not. And to pinpoint the exact entry point, these 10-second candles will come handy. And to define the conditions, we have also considered these calculation expression blocks. Now I will take you back to the JForex chart to give you a brief refresher of how we are defining the logic for the execution of the trade. Now in this session, the focus is going to be on the buy side. We want the buy trade to take place whenever there is sudden jump, sudden spurt in the price on the higher side. And to make sure that is the case, we are taking these two standard deviation values, the last hourly standard deviation value and the value 3 hours back. So there is interval of 2 hours, and also we are considering the price action, and last hourly candle close should be higher than its opening price as well as the prior candle's opening price. So we will be considering the difference between this closing value and the prior candle's opening value, and we will define certain amount of pips that minimum difference should be there. And as I said, we are also considering the prior 4 hourly candle action, whether it is up or down. That is also going to be an important factor, and for the buy trade to execute, we will need the last 4 hourly candle to have closed with gains. Its closing value should be higher than its opening value. Now we go back to the Visual JForex board, which has been developed by the Dukascopy Bank SA. We will take a calculation expression from the mathematical components. Users variable, autocreate it. I will create a new one, and I will give it a value of 10 pips. So minimum difference of 10 pips should be there between the last hourly candle close and the prior hour candle close, candle open. So here we define that We will take A1 into A2. We will take the standard deviation 15, which is the value for the hourly candle which has closed 3 hours back, and multiply it with 2. A1 into A2, standard deviation value is being multiplied by 2. Okay, and for the buy order to be placed, we will have to take the difference of the last hourly candle and the penultimate hourly candle. We will need the difference between candle 16's candle close and candle 17 candle open, and we will take half of it and deduct it from last tick price, which will be our entry point, entry price. A1 into A2. This output we will deduct from last tick price, which then later on can be used as our entry point. We will be using the pending open order command, and we will be using the limit order. That means the order price will be lower than the last tick price. A1 minus A2. Okay, so we have defined these requirements. Now we can start bringing in logical blocks. If block, multiple action. For the time being, I will join it here, and This will be joined here. Okay, we want last hourly candle standard deviation output at least twice of the standard deviation for the candle which has closed 3 hours back, and for that we have carried out this calculation. So first input should be greater than second input. After that we move on to look for the price action data. The 4 hourly candle, which is candle 18, its closing price will need to be higher than its opening price. So we take candle 18, candle close, and compare it with candle open. I will take a couple of these blocks straight away. First input greater than second input. Also, last hourly candle should have closed in a similar manner. Its opening price should be lower than the closing price. So we have to consider candle 16, candle close, and compare it with opening price. First input greater than second input, and then we consider the difference between last hourly candle close and the prior hours candle open by difference, and this difference should be more than 10 pips. Okay, so these are the requirements for any trade to be executed, and whenever we will see that price action starts to dip below the last hourly candle close, we will go to execute the trade. And for that, all we have to do is compare the last hourly candle close value with these closing levels of candle 19 and candle 20, which are 10-second candles with a look back period of 1 and 2 respectively. So here we are going to need candle 16, candle close as the input in both these blocks. Candle 16 is last hourly candle, and the candle 20 candle close should have higher value. First input greater than second input, and candle 19 should have closed lower. After that, we will bring in the trade command block, pending open. This is going to be a limit order by limit. First input less than second input. Price we have already defined. Default instrument remains as it is. Trade amount I will change to 0.1 million. Slippage is going to be 2 pips. Stop loss we are going to use the risk reward ratio of 1:2. Stop loss 15 pips and take profit 30 pips. And order validity, we can keep the order valid for 1 hour, 2 hours or 3 hours as per your assessment. I will not define the order validity in this session. We will leave it for next one. And it depends on how you assess the price action. You can go with the order validity of 1 hour or 2 hours, and it is fairly simple to define. All you have to do is take 3.6 million ticks, those are the ticks in 1 hour, and multiply it with a variable of desired value, and you get the order validity, which needs to be of long data type. We do have to pay attention to the data type of the variable output of this good till time. Okay, so this is the setup so far, which is almost complete but not fully complete. It is not functional yet. We have to define the order validity for the buy side, and then we will need to complete the sell side of the equation, and only after that the algorithm will be complete. But as we are running short on time, I will wrap up the session here. Do come back for more, and if you want to access more of the information, you can check out the Dukascopy analytics page, and you can also follow us on the Facebook. Thank you all for joining in. See you next time. Till then, goodbye.